More than 10% just this week. So let's talk about where prices might be headed from here. Joining me now is Bank of America Securities Global Head of Commodity Research, Francisco Blanche. Francisco, it's great to have you. First, would love your read on what exactly has been pressuring crude here. Obviously, a very bullish story for months. And, you know, the reopening in China seems to have gotten people's attention, or the potential reopening. And yet we still have, you know, a market that's acting like there's plenty of supply there.
Hey, Mike. Thanks for having me. Yeah, I think there are probably four things that have taken oil markets down. First, obviously, is that Russia sanctions haven't really bitten into supply. And part of it is the price cap was set at $60 a barrel, which essentially has meant that we have yet to see meaningful disruptions of Russian barrels following the implementation of the EU sanctions on Russian oil, and also EU sanctions on Russian oil services, such as freight and insurance. And then the other couple of things that have happened is obviously I think there's been some nervousness about the China reopening story, which looked great a couple of weeks ago, but now people are realizing it's going to be a little harder to reopen China than maybe some of the Western economies. And maybe on top of that, OPEC didn't really cut production on Sunday, and they're not going to meet for a couple of months. So I think those three factors, coupled with the fact that, frankly, the macro picture is deteriorating. We've seen a big sell-off or rather, we've seen the two stands in the yield curve in the U.S. pointing to maybe a steeper recession. I think those factors have probably all taken oil prices lower this week. It's been a pretty bad week for the energy markets.
For sure. Now, do you think that all of those forces are going to prevail as we get into next week? I mean, there's still a lot of folks who say, look, the energy stocks have held up okay, natural gas hasn't completely fallen apart, et cetera.
Well, look, I mean, I think it's very important to understand most of the sell-off has been front-loaded. It's been the first, second, third future month contracts. Long-dated oil 5 years out has held up a lot better. And I think it's just a sign the market believes once we get through this air pocket, this patch of weakness, we are going to find a much firmer outlook into the second half of 2023. Remember, once the Fed pivots, once the Chinese truly reopen their economy, we're going to need a lot of oil. And frankly, investment is just not there, as you know, and shale supply has been underperforming in the U.S. So all those factors, I think, will likely take us higher. But we need to see economic growth pick up again. That's the bottom line.
Mm-hmm. We were just talking about the life that's being shown in some of the basic resource stocks, specifically metals. Is that something that you think is justified based on what you think the metals markets or the other industrial commodities might be able to do?
Well, Mike, this is a great point. I mean, we've been arguing that this was going to be a year where you wanted to be long metals versus energy, as opposed to last year where you wanted to be long energy versus metals. There's a bit of a reversal there. And frankly, we are seeing it already, which to me is pretty good omen for energy itself. Because I think the metals markets are very well supported by the energy transition, by the fact that whether China reopens or not, they're going to have to make big investments in their grid. So we really like copper. We have a target for copper of $12,000 per ton. And also, frankly, I think once the Fed pivots, I kind of like gold here, too. I think gold's going to do pretty well. We're looking for $2,000 an ounce next year. So those would be probably our favorite metals. And then, of course, we think the high energy price environment will support aluminum as well.